With low-risk, fixed investment yields at historic lows, many retirees are continuing to invest in aggressive portfolios. Higher returns mean better income and a longer-lasting retirement, but the risk may be too much for retirees to overcome. I'll show you why you should be reducing your investment risk after you retire, coming up next. There are two phases to retirement planning. Most of you are in the accumulation phase, when you're contributing a percentage of your income toward your savings goal. After you retire, though, you move into the withdrawal phase. Here, you're withdrawing funds every year as income. During the withdrawal phase, traditional financial planning theory dictates that you should adjust your investment mix to a much less aggressive position. But with fixed income investment yields at historic lows, many retirees are leaving their funds in aggressive strategies well into retirement. Even with currently low interest rates, there are two reasons you should follow tradition and lower your investment risk after you retire. First is the time you have to recover. Over time, incurring occasional losses in your portfolio is inevitable. It's true that in the long run, markets tend to always go up, but when you're retired, you may not have the time necessary to wait for a recovery. Let's say you've set and reached your savings goal of $500,000 and you decide to retire. But the first year of your retirement happens to coincide with a market crash of 50%. How much do you need to break even? The answer may seem simple. You've lost 50%, so if you gain 50%, you've broken even. But it's not that simple. A 50% loss on $500,000 drops your savings down to $250,000. A 50% gain only brings you back to $375,000. In fact, you need a 100% return to get back to $500,000. A 60% decline requires a 150% return to break even. A 1930s type 80% decline in the market would require 400% just to break even. For younger investors, market crashes should not be too much of a concern. But if you're already retired, remember that it could take years for a market to recover by 100 or 150%. Here's an even more important reason to reduce risk after retirement. It's called sequence of returns. Look at this example. Starting at retirement, let's say you have $500,000 in savings. You continue to invest aggressively for the first 10 years, achieving these returns. Just two relatively small losses compared to some really great gains. Your average rate of return is 8%. The losses in this case are occurred in the later years. What would happen if the losses were in the first few years? Let's reverse all the returns, putting the losses in years 1 and 3. You can see that you achieve the same 8% rate of return, and you have about the same amount of money in the end. But in retirement, though, it's not that simple because you're withdrawing a little bit every year. Let's start at $50,000 in the first year and assume you increase withdrawals by 2% per year to offset inflation. So you'll be withdrawing over $59,000 by the 10th year. When losses are incurred in the later years, you still have over $423,000 left over after withdrawing over $547,000. But here's the catch. When the losses were incurred in the early years, you actually end up running out of money in year 10, and you've only withdrawn $487,000. Both examples have the same 8% rate of return, but periodic withdrawals magnify losses in the early years. This is why it is so important to reduce risk after retirement. It's historically impossible to time the market. An aggressive investor must know that even the most experienced investors will lose periodically. You don't want luck and timing to determine your retirement success and happiness. After retirement, you absolutely want to reduce the amount of risk that you're taking in your portfolio, even if it means accepting relatively low returns. For more financial insights, please subscribe to my channel. I'll be releasing new videos every week covering financial planning, investing, insurance, and tax concepts. If you have a specific financial question you would like to see answered in the form of an animated video, feel free to leave a comment below.